Okay, let's talk about something that really trips up a lot of investors. You can see the stock market, right? Historically, it delivers pretty strong long-term returns, goes up over time, generally. But then you talk to actual individual investors, and, well, so many feel like they've lost out or haven't really seen those big gains themselves. Why is that? Why the gap?
Yeah, it's a really common puzzle. And what's fascinating, and this is what we're digging into today, is that the answer often isn't about the market, doing something weird. It's more about us, the investor.
Not us. How so?
Well, our source for this deep dive is Parag Parikh's book, Stocks to Riches. He was a very experienced investor, a money manager. And his whole angle was looking at the market through behavioral finance, basically how our own human psychology messes with our decisions.
Okay, so less about charts and numbers, more about what's going on in our heads.
Exactly. So our mission here is to pull out some key insights from the book to help you understand what real investing actually looks like and how, well, your own mind can be your biggest enemy or maybe your biggest ally.
Right. So where do we start? What's the first big hurdle Parikh points out?
It starts with a really basic confusion, actually. The difference between proper investing and what most people end up doing, which is more like trading or even just speculating.
Speculating. Like gambling.
Sort of, yeah. He argues many people are just betting on short-term price moves. They're not thinking like owners of a business.
He has that farming analogy, right? The law of the farm.
That's the one. Investing is like planting seeds. You do the work now, you nurture it, and you expect a harvest way down the line. It's long-term, requires patience. Trading, on the other hand, is like, well, it's like trying to guess if the crops will look a tiny bit taller tomorrow because it was sunny today. Very short-term focus.
Okay, that makes sense. And he had an example.
Oh, a classic one. Infosys, back during the dot-com mania. The stock price just went absolutely crazy, sky high, totally detached from what the actual company was earning or doing. Pure speculation was driving it.
Right, I remember that era.
So when that bubble inevitably popped, people who were just trading the price, chasing momentum, they got wiped out. Huge losses.
Ouch.
But the people who'd invested earlier, based on Infosys being a solid company with good long-term prospects, and just held on through that madness, they ultimately did very well because the business kept growing. They focused on the value, not the temporary price insanity.
So focus on the farm, not the daily weather report.
You got it. But why is that so hard for us? That brings us to the psychology.
The brain traps.
Exactly. Our brains use these mental shortcuts heuristics to make quick judgments, but they often lead to biases, irrational decisions. Two really big ones he talks about are loss aversion and the sunk cost fallacy.
Loss aversion, that's the one where losing hurts more than winning feels good.
Precisely. Psychologists say a loss stings about twice as much emotionally as an equivalent gain feels pleasant.
Wow, twice as much.
Yeah. And think how that plays out. If a stock you own goes up a bit, you feel that pressure, that anxiety. What if it goes back down? So you sell it quickly, lock in that small profit, just to avoid the potential pain of losing the gain.
Ah, okay. Taking profits too soon.
Yep. And the flip side, if a stock goes down, the pain of selling and admitting you made a mistake, actually realizing that loss, it's intense. So people hold on, hoping, praying it'll just get back to what they paid.
Yeah.
Even if the company's situation has totally changed for the worse.
So you cut your winners short and let your losers run potentially into the ground.
It's a classic destructive pattern.
Yeah.
And it's driven by that emotional bias, not logic.
And that ties into the sunk cost thing too, doesn't it?
Absolutely. Sunk cost fallacy is, well, it's when you keep throwing good money after bad, basically. You've already put time or money into something, so even if it's clearly failing, you stick with it just because of the past investment. You feel you need to justify the initial decision.
Like holding on to that losing stock just because you paid so much for it originally, even if you wouldn't dream of buying it at today's price.
That's exactly it. You're letting the past cost dictate your future decision, instead of assessing the situation objectively right now.
Man, these biases are powerful.
Yeah.
And they're working inside us individually.
They are. But then Parikh adds another layer of complexity. The crowd. Herd mentality.
Following the herd, buying when everyone else is buying, selling when they're selling.
We're social creatures, right? We have this deep instinct to follow the group, often overriding our own judgment. It feels safer in the crowd.
Even if the crowd is running towards a cliff.
Unfortunately, yes. He uses the example of a sharp market crash in India, May 2004. There was some political uncertainty after an election. Fundamentally, companies hadn't suddenly become worthless overnight, but panic set in. Selling started, Then it triggered more selling.
A cascade.
A total cascade. People weren't reacting to company news. They were reacting to the fear they saw in other sellers. The herd was stampeding, driven purely by sentiment.
Okay, so understanding these individual biases and the herd effect is critical.
It's absolutely fundamental, according to Parikh. Success isn't just about picking stocks. It's maybe even more about managing your own emotions and reactions.
So bringing this home for you listening,
Right.
what's the big takeaway?
It's that awareness is the first huge step. Knowing about loss aversion, sunk costs, the pull of the herd, just being aware that these forces are acting on you.
Because if you know the traps exist, maybe you can avoid falling into them.
Maybe. And Parikh's insight suggests something quite challenging. Often, the smartest move in investing is the one that feels the most uncomfortable emotionally.
Like buying when everyone else is panicking or selling when everyone's euphoric, going against the grain.
Exactly. Sticking to your long-term plan based on value when fear and greed are swirling all around you.
That takes real discipline.
It really does. So the final thought to leave you with is this. How can you cultivate that emotional strength, that discipline to follow your plan when the crowd and your own instincts might be pulling you in the opposite direction?
That's definitely something to think about.